Imagine a company that builds some of the most complex microscopic lasers on Earth.
Right.
We're talking about the exact physical technology that is basically keeping this entire current AI boom from just grinding to a complete halt.
Yeah, the literal physical bottlenecks.
Exactly. Now, imagine the stock market valuing that pure play foundational company at like 10 times less than the companies whose main job is just putting those lasers into standard packaging.
It sounds completely backwards, I know.
Welcome to the deep dive. Today, we're analyzing this incredibly passionate, highly detailed investor thesis.
From a source text titled Eingefickter Text, yeah.
Yeah, and it's all about this massive looming hardware bottleneck in the tech world. Our mission today is to decode this complex financial thesis, really understand the microscopic hardware powering the AI boom, and explore why the stock market might be wildly mispricing the companies building our future.
Right, the company's doing the actual heavy lifting.
Spot on. So if you're wondering how all those massive AI systems actually connect, this is definitely for you. Okay, let's unpack this.
Before we get into the mechanics of this thesis, I think we really need to establish some parameters for our analysis today.
Sure, yeah.
We are strictly examining the underlying structural shifts in the tech market. The supply chain dynamics laid out in the source.
Right, the fundamentals.
Exactly. We are absolutely not providing financial advice here.
Oh, definitely no.
The author of the thesis explicitly includes a do your own research and no financial advice disclaimer, and that's our stance as well. The goal here is just to understand how these systems actually function under the hood.
Yeah, we're not trying to trigger any trading decisions.
Right.
So to grasp this hidden gem our source thinks they found, we really can't start with the future. We have to look at the massive bottleneck that exists right now.
The current paradigm.
Yeah, and the whole thesis kind of hinges on an acronym that honestly sounds totally impenetrable at first.
Oh, you mean the AMP-CWDFD lasers?
Yes, that exact one, indium phosphide lasers. The source really frames this as the ultimate choke point for our current generation infrastructure.
It really is.
Yeah.
So that acronym stands for Continuous Wave Distributed Feedback Lasers, and they're built on an indium phosphide substrate.
Okay, break that down for us. Why indium phosphide?
Well, the reason this specific material is a bottleneck really comes down to just pure physics.
Okay.
See, the standard silicon that we use to build those massive GPU chips for artificial intelligence.
Like the ones NVIDIA makes.
Exactly. That silicon is what's called an indirect bandgap material.
Which means what, practically?
Without getting too bogged down in the quantum mechanics, it basically means silicon is fantastic at processing electrical logic, right?
Right.
But it is fundamentally terrible at emitting light.
Oh, wow. I didn't know that.
Yeah, so to actually generate the photons you need to send data across a massive data center, you're forced to use these exotic, heavily engineered materials.
Like indium phosphide.
Exactly.
I was reading through the technical specs on this before we started, and the best way I could conceptualize it, think of those massive NVIDIA GPUs as like brilliant, world-class scholars.
Okay, I like this.
Right. They process complex info at lightning speed, but they only speak a highly localized language, which is electrons.
Right, electrical signals.
Exactly. So if they try to shout to another scholar across the room using electrons over copper wires, the message degrades.
Oh yeah, and it generates massive heat.
And it's incredibly slow. So these indium phosphide lasers act as the simultaneous translators.
That's a really good way to put it.
They sit right next to the scholar, take that electrical thought, translate it instantly into a photon, a pulse of light, and shoot it across a fiber optic cable.
With essentially zero friction.
Right, and if the translator is slow, or if you just don't have enough of them, the genius of the scholar is completely wasted.
And the consequence of that dynamic, that's exactly what drives the extreme valuations we see in the hardware sector right now.
Right.
What's fascinating here is the economics of this. It's a situation of zero substitution elasticity.
Meaning you can't just swap it out for something else.
Precisely. In these highly optimized supply chains, the company making the least glamorous microscopic component often holds the entire industry hostage.
Because you literally cannot build a billion-dollar AI server cluster without these specific lasers.
No, you can't. There's no software workaround for a missing physical photon.
Which perfectly explains the historic run of a company called LITE, ticker symbol LITE.
Oh yeah, light is a perfect case study here.
The source points to them as the prime example of what happens when you hold the keys to a bottleneck.
They're supplying these crucial lasers to companies like InnoLight and the Optolink for the current optical transceiver cycles.
And because they completely dominated that supply, the market just aggressively re-rated their stock. I mean, it went from around $16 all the way up to $622.
Which is staggering. But that kind of multiple expansion happens when institutional capital suddenly realizes, oh, this bottleneck is structural, not just temporary.
Right. Light wasn't just participating in the AI boom.
Exactly. They were gatekeeping it. But, the fundamental law of data center architecture is that thermodynamics are always pushing the industry into the next paradigm.
You can't beat heat.
You really can't.
And that thermodynamic wall is exactly the friction driving the main argument of this thesis. Because the cycle 8 is dominant, that's the current paradigm.
Right.
But you can only push so much data through that current setup before the physical heat of the electrical connections literally just melts the motherboard.
Yeah, the copper trace just gets too hot.
So the source notes that to survive, the industry spearheaded by giants like NVIDIA, they're being forced to shift towards CPO.
Co-packaged optics.
Yes, and silicon photonics.
And this transition to CPO, it's a desperate necessity. It's really not just an iterative upgrade.
How so?
Well, right now, data has to travel electrically from the processor chip across maybe a couple inches of copper trace to reach the optical transceiver plugged into the edge of the board.
Right, the edge pluggables.
Exactly. Pushing high-speed data across that copper creates exponential electrical resistance.
Which equals heat.
Massive heat. So CPO solves this by taking that laser and packaging it directly onto the same substrate as the processor itself.
Oh, wow. So we're moving the simultaneous translator off the edge of the desk and putting them literally inside the scholar's brain.
Basically, yeah. The data converts to light almost immediately, and you entirely bypass that copper heat problem.
That is wild. And according to the supply chain breakdown in this thesis, there is a company quietly positioning itself to be the primary laser supplier for this impending CPO ramp-up.
The mini-LITE, as the source calls them.
Right, a company called Sivers, ticker SIVE.
Yeah, Sivers.
The source notes Sivers is supplying the lasers for companies like Poet, Starlight, Ayar Supernova, and basically the others building these next-generation architectures.
And this is where the author highlights just a severe structural mispricing by the market.
Yes, the valuation gap.
We just established that the core irreplaceable tech required to make CPO function is the laser itself.
The actual physics.
Right. But Sivers, the pure-play manufacturer engineering that physics, is valued by the market at roughly $130 million to $140 million.
Which, I mean, I had to read the numbers in the source text like 3 times to make sure I wasn't dropping a zero somewhere.
Yeah, $140 million in global tech hardware is just a rounding error.
Exactly. But the shock isn't just that absolute number, it's the relative valuation compared to the rest of the supply chain.
Right. Let's look at Poet.
Yeah, the source points out that Poet is essentially doing the advanced packaging for Sivers-type lasers.
They're integrating the components.
Right, they're just putting a box around it. Yet Poet commands a valuation that is 9 to 11 times higher than Sivers.
It's incredible.
Wait, the company making the actual foundational laser is worth 10 times less than the company integrating it? The source also compares this to the broader market, right?
Yeah, they note an advanced packaging company like FN is valued at $400 billion.
Billion with a B.
Yes. While the core current generation laser maker, LA Key, is only at $40 billion.
Does that make any sense at all?
Well, this raises an important question about how capital actually flows in these complex technical markets.
Okay, tell me.
Wall Street has a profound bias toward the top of the integration stack.
What do you mean by that?
Well, investors, and especially algorithmic screeners, they tend to reward the companies that package, integrate, and deliver the final module.
Because it's easier to understand?
Partially, yes. Their business models are just easier to model in a spreadsheet. Integrating components feels like a predictable, standard manufacturing process.
Ah, I see.
But engineering the quantum well of an indium phosphide laser, that involves material science risk.
Which analysts don't like.
Most financial analysts simply do not have the background to underwrite that kind of physics risk.
So they just buy the packager and completely ignore the physics?
Pretty much.
And the hype machine distorts it even further, right? The thesis mentions this company called LWLG.
Oh, right, the pre-revenue science project.
Yeah, the author literally describes them as a pre-revenue science project working with TIAS. And this pre-revenue concept is carrying a valuation of over $1 billion.
While Sivers sits at $140 million manufacturing actual physical product.
It creates this bizarre reality. The market is just throwing billions at theoretical potential, while starving the companies at the bottom of the trench doing the actual labor.
It's the classic story stock versus execution stock divergence.
Right.
A pre-revenue company can promise the world because, well, they haven't collided with the harsh realities of commercial manufacturing yields yet.
Their narrative is totally flawless.
Exactly. Sivers, conversely, is operating in the messy, difficult reality of actually building hardware. That makes them inherently less shiny to speculative capital.
Okay, but look, if we're going to rely on this source text, we can't just blindly accept that the market is wrong and Sivers is perfect.
No, definitely not.
We have to assume the market might be ignoring Sivers for a highly rational reason.
We need to look at the underlying business.
Exactly. Do they actually have the leverage to survive this transition? So let's look at their pipeline and their partners.
The source notes Sivers is actively supplying lasers to Ayar.
Which is a massive signal.
Huge. Ayar connects directly into the ecosystems of NVIDIA and Intel.
Right. And they're also supplying Marvell Celestial through Poeti. And there are even those unconfirmed hints from past earnings calls about connections to heavyweights like light matter.
The integration into Ayar and Marvell is the critical variable here,
Why is that the make or break?
because you do not get qualified into those supply chains by accident. Those companies are designing the foundational architecture for the hyperscalers, the massive data centers run by the biggest tech companies on Earth.
The Googles and Amazons of the world?
Exactly. So if your component is designed into an Ayar or Marvell reference board, you are effectively hardwired into the rollout of the next generation of global computing.
Wow. And the forward-looking numbers provided in the thesis really reflect that positioning. I mean, Sivers is citing an expected $453 million pipeline over the next few years.
Plus, they have a completely separate LiDAR segment.
Oh, right, the spatial mapping tech for autonomous systems.
Yeah, and that's currently ramping up with another $53 million to $138 million in projected revenue.
So this thesis presents a scenario where a company capped at roughly $140 million is sitting on a multi-year pipeline that could easily exceed $500 million.
On paper, yes. But a pipeline is just a projection on a slide deck until you can actually manufacture the product at scale.
Right.
The transition from the lab to the fab is where most hardware startups die.
Which makes another detail from the source super critical. Sivers has, quote, Win Semi-Foundry qualification in progress.
And WinSemi is a major player.
Right. Getting qualified there means Sivers is aggressively moving to secure the high-volume production capacity they actually need to fulfill that $500 million pipeline.
But scaling up requires capital.
Always does.
And in hardware, capital usually means crippling debt. Financial leverage is really the silent killer in the hardware space.
So how does Sivers' balance sheet look?
When we examine it as outlined in the text, we see a remarkably lean structure for a company attempting to scale.
Right. The source notes they just cleaned up their debt a few weeks ago.
Yeah, they refinanced to a $12 million convertible loan at 10.85% and a $5 million term loan at 12%.
So $17 million in total debt.
Exactly.
The author contrasts this directly with a competitor like AAOI.
Oh, yeah. AAOI is notoriously conducting $500 million at the market offerings.
Which basically means AAOI is forced to massively dilute their own shareholders on a rolling basis just to keep the lights on.
Just to fund operations, yeah. Sivers is carrying a fraction of that burden.
Okay, so let's recap this. They have the foundational tech. They are plugged into the elite tier of hyperscaler partners. They have the foundry capacity in progress, and their debt is highly manageable.
That's the setup, yes.
Why on earth is Wall Street ignoring them?
Well,
Actually, wait, here's where it gets really interesting. The source points out a structural geographic detail that might be the actual culprit.
the exchange listing.
Yes. Sivers is listed on the OMX Nordic Exchange.
The geographic blind spot.
Yeah.
It is honestly one of the most persistent inefficiencies in global finance.
I was absolutely floored by this. The author compares Sivers to a microcap company called AXTI, which was completely ignored by the market before it suddenly gained massive attention for a substrate bottleneck.
Very similar trajectory.
Is it truly possible that a company holding the keys to a vital AI hardware bottleneck is being valued at 10x less than its peers simply because massive U.S. hedge funds don't run automated screeners for Swedish microcaps?
It is not just possible. It is standard operating procedure for institutional capital.
Really? Just because of the geography?
Yeah. The overwhelming majority of U.S. institutional liquidity is heavily ring-fenced around the NASDAQ and the NYSE. The compliance algorithms, the daily analyst screeners, the index inclusions, they are entirely localized.
So if you're not in their backyard, you don't exist.
Exactly. Unless a foreign small-cap tech company dual lists in the U.S., or until their actual realized revenue growth becomes so incredibly loud that it forces international attention, they exist in a vacuum.
Wow.
Wall Street does not casually browse the OMX Nordic exchange, looking for deeply technical semiconductor bottlenecks. Sivers is functionally invisible to the largest pools of capital on the planet right now.
Okay, a $500 million pipeline, elite partnerships, a microscopic valuation, and literally an institutional invisibility cloak.
It's quite a narrative.
The author paints this as the ultimate asymmetric setup, but every deep dive requires us to find the friction. We have to look at the cliff edge.
Always.
What is the downside risk here?
Well, the source is highly transparent about the execution risks, and they are significant.
Okay, like what?
Look, designing a pristine indium phosphide laser in a laboratory environment is an engineering triumph.
Sure.
Manufacturing millions of them flawlessly, with zero defect tolerance, across a global supply chain, that is an entirely different discipline.
It's a massive leap.
And furthermore, even with their current debt cleanup, moving into mass production against incumbent giants is going to require future capital.
Which brings the ever-present threat of shareholder dilution.
Always a risk in hardware, yes.
And let's talk about those incumbent giants, because that is the massive elephant in the room here.
Oh, absolutely.
You don't just announce that you're the mini-LITE and expect the actual LITE to just, hand over the keys to the kingdom.
Not going to go quietly.
Right. The source explicitly mentions that both LITE and another giant, COHR, are scaling up massively for this exact CPO transition.
And they are incredibly well-funded.
Exactly. They aren't bootstrapping it. NVIDIA just handed them a combined $4 billion war chest to secure their optical supply chains.
Which is a terrifying number for a competitor.
Right. So how does Sivers survive that? How do
Yeah.
you fight a competitor that just received a $4 billion check from the most powerful tech company on the planet?
It sounds impossible. But if we connect this to the bigger picture of enterprise hardware procurement, the answer is actually dictated by the tech giants themselves.
Really? How so?
The source text highlights a highly specific dynamic to counter this incumbent threat, and that's multi-sourcing.
Okay, explain that.
The author notes that Ayar multi-sources its lasers from LITE, Sumitomo, MTSI, and Sivers.
So they spread it out.
Exactly. In consumer markets, a $4 billion war chest allows a giant to ruthlessly price out competitors and establish a total monopoly.
Right, like an Amazon tactic.
But the enterprise data center market actively forbids monopolies at the component level.
Oh,
Yeah,
because if you only have one supplier, you have a single point of failure.
exactly that. The hyperscalers learned a brutal lesson during the pandemic supply chain collapses.
I remember that you couldn't get chips for anything.
Right, if a single factory in one hemisphere goes offline due to a fire or a geopolitical shock, and you only buy from late.
Your entire multi-billion-dollar server rollout just freezes instantly.
Instantly. So the tech giants intentionally nurture secondary and tertiary suppliers.
They keep them alive on purpose.
They will actively carve out market share for smaller players like Sivers, simply to ensure that the ecosystem remains resilient and pricing remains, somewhat competitive.
So Sivers doesn't actually have to kill LITE.
No, not at all.
Yeah.
They just have to prove they are a reliable secondary node in a multi-source network.
That makes a lot of sense. But there's one fundamental risk that no amount of multi-sourcing can solve, and that's the risk of timing.
Oh, yes. The calendar.
Right. The entire thesis relies on the transition to co-packaged optics happening right now. But what if the industry hits a technical hurdle and decides to delay CPO?
It happens all the time in tech.
What if they find a way to squeeze, 5 more years of performance out of the current architectures? If the architectural shift is delayed, Sivers' massive projected pipeline simply evaporates into the future.
Timing an architectural shift in the semiconductor industry is notoriously punishing. You could be entirely right about the physics and entirely wrong about the calendar.
Right.
Sivers is making an aggressive bet that the thermodynamic wall is insurmountable and that the future must arrive exactly on schedule.
And if the industry stalls?
If the industry stalls, a lean balance sheet will only buy them so much time before that pipeline dries up completely.
Wow. So what does this all mean? We have covered a massive amount of technical and financial ground today.
We really have.
We started by exploring the current thermodynamic bottleneck, right? Those NNP CW DFB lasers acting as the critical translators for our data centers, and how dominating that space triggered a historic re-rating for LITE.
From $16 to over $600.
Insane. Then we unpacked the baffling market psychology that rewards the companies putting lasers into boxes 10 times more than the companies engineering the core physics.
The packaging versus physics dilemma.
We looked at Sivers' $500 million pipeline, their elite hyperscaler connections, and the very real possibility that being listed in Sweden is keeping them entirely hidden from Wall Street's algorithms.
We also stress-tested the thesis against the harsh realities of execution risk, the threat of those well-funded incumbent giants, and the critical survival mechanism of enterprise multi-sourcing.
Why does this deep dive matter to you? Because the mainstream conversation around artificial intelligence is almost entirely focused on software right now.
Right. Algorithms and chatbots.
Exactly. We talk about parameters and code and applications, but the true limiting factor of the future is incredibly dense, physical, microscopic hardware.
You can't code your way out of thermodynamics.
No, you can't. Understanding these obscure supply chains, knowing the difference between an integrated packager and a pure-play physics manufacturer, gives you a completely different lens on how the global tech economy actually functions behind all the press releases.
And as we conclude our analysis of this thesis, I really want to leave you with a broader implication to consider.
Yeah, let's hear it.
The source notes that the shift to co-packaged optics isn't just a slight upgrade. It is designed to completely replace the pluggable transceivers that currently dominate these hyperscaler architectures.
Okay.
This raises an important question. If CPO successfully takes over and physically integrates the laser directly onto the compute die,
Right.
what happens to the massive multi-billion-dollar corporate empires whose entire business models are currently built on manufacturing and selling those standalone pluggable transceivers?
Oh, wow.
Are we currently looking at the peak valuations of companies that are about to become a massive graveyard of obsolete tech giants in just a few short years?
That is a brutal reminder that in hardware, your greatest innovation today is just the thermodynamic hurdle waiting to be bypassed tomorrow. Something to keep in mind the next time you hear someone talk about the limitless potential of the cloud.